Today, we're going to go through the ultimate guide to home prices in 2024. I'm joined by my good friend, Luke Blankenship, a real estate professional and insurance guy extraordinaire.
Thank you for having me, man. I'm excited to be here. Okay, so what are your predictions for home prices in 2024?
These aren't my predictions, but we're going to go through 12 national forecast predictions for 2024. This data was put together and aggregated by Resi Club, so thank you for doing that. And if you don't have one of their premium memberships, I think people should subscribe to that. But here's what's very interesting. For the people who don't want to listen to the whole thing, what do we think? Do we think home prices are going to be up or down next year? Like, where do you think they're going?
I would say they're probably going to go up just based on interest rate forecasts.
Yeah.
I mean, the whole reason that there's pressure on them at the moment is because of what interest rates have done.
Yeah.
And the reality of it is that if you look at the stats, the last few years, like during COVID and all that, we saw ridiculous appreciation. And so it's come down, like 30%, 27%, something like that in local areas. But it was up like 60 something percent, which is just, it's not real, really. But so interest rates got really low during COVID. Yep.
Home prices shot way up. The forecast basically in aggregate, 7 of them say that they're going to be up. 1 says flat, 4 says down. On an average, they say 0.8%. Now, of course, there's more bulls than bears in this particular forecast here. So the Mortgage Bankers Association, they forecast that, and they used FHFA as the measurement, that home prices will rise 4.1% in 2024. And then what's interesting is then they expect it to slow down in 25 and 26. I think it's actually probably a little bit the opposite of what the Mortgage Bankers Association. If you look at where the Fed is projecting interest rates to go, the Fed is projecting that interest rates will trend down over the next 3 years. So as homes become more affordable, I believe home prices would rise more. I mean, that's what kind of makes sense.
Yeah, and I think too, when looking at some of these statistics, we live in a very unique area in the sense that the job market here is extremely strong. I mean, even like the trade specifically is paying like a ton of money. Like, a lot of my friends are in the trades and they're electricians or plumbers, and they get paid a lot of money depending on like what jobs they're doing. Like you can't even find an electrician really around here for less than like $120 an hour.
Yeah. Yeah.
So all of those people are still able to afford, at least locally where we are.
Yeah.
Which is going to keep that home prices on the rise.
So later on, we'll get into exactly where we think we're going in the Seattle Metro, and that's where Luke and I are right now. The AEI Housing Center, that think tank predicts 4%, and so we're going from low to high. CoreLogic, they predict that the CoreLogic Home Price Index will rise by 2.9. Fannie Mae predicts that U.S. home prices will rise by 2.8%, followed by a slight dip of negative 0.4 in 2025. So I'd like to know what's Fannie Mae thinking there as to, why do we go up in 24 and then dip afterwards? Freddie Mac, they're proposing 2.6. Goldman Sachs. So Goldman Sachs, they actually just revised their forecast. And so they like to go with the Case-Shiller Index. Now, the Case-Shiller Index, for everyone who's listening to know, is that Case-Shiller is always lagging. So Case-Shiller is always 60 days, sometimes 90 days behind what's happening. So when the news reports Case-Shiller and a lot of these big financial institutions like Case-Shiller, that's old data. I like, stuff we get right out of our MLS, our own data that we crank out. I like the Redfin data center because it updates all the time. Some of these are more up to date. Next, National Association of Realtors. Like, come on, guys. NAR only predicts home prices go up by 0.7%. And that's our trade group, which is very interesting. So they're super conservative on their home price increase, but this is where their prediction flips. NAR predicts we go to 4.71 million home sales in 2024. So right now it looks like we'll finish at about 4.1. So they expect home sales, not prices, to go up 13.5% next year, just because interest rates coming down slightly. What are your thoughts? Do you think we could do 13, 15% more home sales next year?
I think, at least in this local area, which is where I'm more versed in, I think the biggest bottleneck is going to be inventory. At the moment, I personally think that's my only thing I can see as to why home prices are still increasing with interest rates being as high as they are, if you go in, if you list a house in this area and it's right at that like affordability line, so to speak, 500,000, 550,000, you'll get like 15 showings or more showings, like right off the rip, like, like a few days on the market. So there's people that are all still chomping at the bit to get in. But I think that the reason why it's like that is because there's so few options in the first place. I mean, at any given time, there's like 4 homes for sale in the $500, in all of like Marysville or something,
Yes.
And then all of those buyers that are going and looking at your house, they're going and looking at the others. So if inventory were to come up, I can understand where some of these predictions like that we were talking about, where there could be a dip, where maybe like builders are getting like cheaper money and they're able to continue on with projects or whatever it may be. But that's kind of my viewpoint and prediction on the whole thing.
I love it. So Redfin, they're forecasting 0. So Redfin is the only one on the list that went for flat. Zillow, with their home price value index, they predict minus 0.1. So now we've moved from the people who were all predicting up to the people who are predicting down. Okay. Realtor.com predicts that the median home price will fall 1.7%. Now this one's really interesting. So Morgan Stanley, another investment bank, they predict U.S. home prices, as tracked by Case-Shiller, will fall 3% in 2024 because they've got a couple different cases here. So Morgan Stanley makes a bear case for home prices, and the bear case is that prices fall 8%. And their bull case is that prices actually jump 5%. So their total prediction is -3, but they're like bookending their prediction. Like, hey, best case scenario, you get 5%. Worst case scenario, it drops.
They're basically saying depending on what direction the variables go.
Bingo. When people make these 2024 home price predictions, there's so many variables that go into it. No one's ever 100% correct. And then these predictions actually change on a monthly basis as new data comes in.
Well, yeah, they should.
As things change, because the economy affects it, supply affects it, the supply of materials, how much new construction is happening, consumer confidence, all of these things. Moody's Analytics, last but not least, their chief economist Mark Zandi is predicting that home prices fall by 4.4% across the U.S. So as we've gone through this, do either one of you want to revise or give me your thoughts on where you think nationally home prices are going? What's your closing thoughts on this?
I would say typically, I guess the rule of thumb is that on the coastlines, you usually have a more expensive real estate because we have higher paying jobs here.
Yep.
I think that possibly, and this is just a total guess, but I would say that maybe in like certain areas like, Illinois, for example. Actually, I know someone who works for Boeing that lived in Illinois for a minute before she got transferred to Florida. And in the time that she bought her house in like 2020 to when she sold it, I think in either early 2023 or maybe it was like as interest rates started rising in 22, she made no money on it, actually.
Yeah.
Literally made no money.
Wow.
So like, I think she actually had to bring like a few grand to the table after paying like fees and stuff. So there are areas in this country, even in major metros, that just don't see the same appreciation that we do, which I feel obviously brings down some of these, the numbers on some of these predictions.
Yes.
So I think in certain areas like that, it probably will get hit harder. In areas like this, where there's like a ton of people, I would say, at least in my own personal experience, who are just sitting on the sidelines waiting for affordability to come back down, I think it's going to be just like a strong market again as soon as interest rates come down. It's kind of what happened in like Silicon Valley during the housing crisis in 2008. Home prices, I don't think were even affected. I mean, maybe correct me if I'm wrong, but I don't think home prices were affected all that much because there's so many high paying jobs there.
A lot of people had money over there, so they were just like, whatever.
Yeah, exactly. Yeah,
That's exactly.
You know what I mean? They're like, I don't care.
Yeah.
Yeah. So I think in this local area, I think we're going to see home prices come up as you see interest rates start to come down. I think it's going to just like move in a way to where home prices come down, more people start jumping in the game because that bar comes down for what they can obtain now.
100%, 100%.
What do you think would cause home prices to rise in the area? We kind of touched on that, but
let's go through this specifically. Like, what does cause home prices to rise, whether we're talking here locally in the Seattle metro or just nationwide? Interest rates are one of the biggest factors with home prices because as interest rates go down, a 1% change in interest rate creates a 10% change in the buyer's affordability. So we know that rates just peaked at about like 8.2 and that the Federal Reserve has started Because they paused, interest rates have started coming down. So when I looked yesterday, the average rate was like 6.65. So just that change between 8.2 to 6.65 is over 1 percentage point. So that's caused affordability to increase. Next, which is probably, this one is probably one of the most important, a strong economy. So if the economy is growing or the economy is strong, then what happens is people then have consumer confidence, because consumer confidence plays a big part in this too. If consumers aren't confident, they buy homes. If consumers are confident, they buy homes. And that consumer confidence is based on how secure do I feel in my job? Is the economy growing? Is my stock portfolio growing? And do I feel like I have a strong future? What's really affected home prices once we get past these is inventory. So we keep bringing it up, but we have to keep pounding this. During the Great Recession, 2008, 9, 10, 11, and 12, builders just built less homes because they got their asses handed to them right there in 2006 and 2007. So banks didn't want to give builders money because of all the foreclosures. So that 4-year gap has put us nationally behind somewhere between 4 million to 4.5 million units. And then here in the Seattle Metro, we are, according to the Master Builders Association, we're about 2 years behind on housing. And it doesn't look like we're doing anything on the regulatory side to help us catch up there. The next is then, of course, just buyer demand. But buyer demand is a function of the economy and of interest rates. So if buyer demand goes up, of course, less supply, lack of new construction. One of the things that's very interesting here in the Seattle Metro, and this, applies to actually most of the West Coast. So if you look at where all the construction is happening, all the construction across the U.S. is happening in the Midwest and really in the South. So those places are experiencing construction booms. The problem is in these high demand, high job areas that are on the coast, like the West Coast, aka Seattle, where we live, we're not experiencing construction booms. We're experiencing construction slowdowns. So that's going to exacerbate that problem even further. I was speaking with the largest local developer who is one of my good friends, one of my mentors. And I asked him, I said, what are you seeing right now in regards to builder and developer demand? He said, all of the nationals called me in the last 2 weeks and asked, do you have anything that you'd like to sell? We're worried about 2025.
Because they don't have anything in the pipeline to build on?
Because they don't have enough in the pipeline. And so, of course, we're talking about the Seattle Metro right now, but anywhere there's that lack of new construction, that's going to cause prices to rise. Another thing that caused prices to rise is speculation. Let's put it in a new term, FOMO.
Yep.
When people start this fear of missing out and they start speculating because everyone's buying a house or everyone's buying an Airbnb or everyone's buying a rental, that really can drive up pricing, creating that lack of supply, creating increased demand because of the lack of supply. And lastly, as monetary policy changes, lending standards decrease. So the Fed, as they ramped up interest rates, that caused banks to increase their lending standards. As the Fed stops hiking, which they've most likely stopped, and we've talked about this in previous episodes. So if you're not listening, subscribe. You got to hit those episodes. You got to be following along with us. But the Fed is essentially paused. So that means we've probably hit peak tight monetary policy. So as monetary policy decreases, lending standards, they lag that by 6 months to a year. Lending standards will then follow, which as it gets easier to purchase, more investors purchase.
So do you mean when talking lending standards, you mean like the requirements, maybe like credit score,
yes,
debt to income or something like that?
Yes.
So
down payment.
Just so I understand this correctly, when interest rates go down, lending standards go down, or do they increase?
They go down. So they go down.
So it gets easier.
Bingo. So it's like a double.
Cheaper and easier.
Bingo.
Yeah.
It's a double whammy. Leads to speculation, which leads to FOMO, which leads to potential bubbles.
Which actually really did happen in this last one. I mean, I sold somebody a house who, I mean, he's in the financial world, and he like, you know, I think he works for a financial advisor, and he knew that he had to buy a house, and he's like, I know I can make a play over 1 year and just get out. And that's exactly what he did. Bought like a C property. It was like a new construction, but in like a terrible location and like down in a hole somewhere in Arlington, like down this weird road. And it was just weird. But nonetheless, he bought the home and sold it and cleared like 90 grand the year after. Like 1 year.
Wow.
On the nose.
Yeah.
And so, I mean, it really did.
What year was that?
That was, I think, 21 to 22, I believe. I think he sold like right as like we were starting to hear, or maybe it was 20 to 21. It was, I remember we were selling around the time interest rates were starting to, there was talks of it. You know what I mean?
Yeah.
He was like, I'm out.
Brilliant.
So really, I mean, there were people who did profit off of the bubble if they were able to keep their composure, essentially. And he had a plan, an entry and an exit plan, basically.
A hardcore investor who knows and understands their criteria and their metrics and what the market is doing will always be able to profit off the market, whether the market's up, flat, or down.
Right.
Because if they understand it, they can play against the FOMO or against the fear or with the rates or against the rates. The mistake massive investors make is they don't do the research, they don't learn the market. And so what they're doing is they're betting instead of making a calculated risk.
Right.
And your friend just killed it with that calculated risk.
Exactly. What would you forecast that you would like, you know, we were talking about some of these other people like I think it was Redfin and some other like Morgan Stanley or somebody was saying that they also predict that there's a possibility that the market home prices could go down.
Yeah.
My question is, why are they saying that? Like, what is their prediction for why it would go down? Because for me, I just see interest rates are going to come down, and I think home prices are coming up.
Yeah. So
what's the variable there?
So right now, we are personally betting, and betting our own money that interest rates will come down, supply will stay low, and that the market will appreciate. But there's massive factors that can affect this. So let's go. Why did the Fed raise interest rates to begin with?
Because of inflation.
Because of inflation.
Yeah, because they kept them so low and cheap money, and they had to go vacuum it up, basically.
100%. So if inflation reared its ugly head, could the Fed potentially raise rates again? Yes or yes?
Yeah.
Perfect.
Or just say we're not lowering them like we said we were going to.
Exactly.
Yeah.
So that could adversely affect home prices.
Okay.
Rises in unemployment. So the unemployment rate right now is rising, okay? You can see the Fed doing that, and you can see the Fed talking about where they believe it's going to end up by the end of 2024. I believe the prediction was like 4.7 or somewhere right around there as the unemployment rate. But if unemployment jumps and all of a sudden we're in the 5s or the 6s, see, our whole economy is based on consumerism.
Mm-hmm. No, literally.
So if that consumer breaks, then what happens is, I can't pay my credit cards, my car payments, things like that. Well, does that then turn around and affect rents and housing prices? Yeah, 100%.
Absolutely.
It's a domino, okay? So a massive rise in inventory could also cause this. Well, what would cause rises in inventory?
Lack of affordability.
Lack of affordability is one. Foreclosures. Okay, so let's go back to that consumer. That consumer breaks. They can't afford it. Unemployment's high. So all of a sudden we have a rise in bankruptcies, a rise in foreclosures. Foreclosures at an all-time low right now. And foreclosures peaked out at 4% during the Great Recession. And right now we're at 0.4.
Yeah, I heard a number of people talking about if there were to be someone who couldn't afford their home that they had bought when interest rates were low, more than likely they have a bunch of equity in it. And it would just show up as inventory, as normal inventory rather than a foreclosure. Because they could just throw it on the market because they probably have enough skin there to get out.
100%. I 9,000% agree with you. We most likely won't see a rise in foreclosures because most of the U.S. has created so much equity over the last few years. But we're talking about what would cause prices to go down. So if that consumer just gets really beat up, unemployment really rises, that could cause inventory to rise. And it starts with the consumer. Consumer confidence actually went up according to the consumer confidence survey that just came out yesterday. Went up just a little bit. But if consumer confidence gets too low, and the psyche of the consumer is beat up because unemployment, because wars, because inflation, natural disaster. If that consumer really stops spending, the whole U.S. economy breaks. Also, lending standards have gotten tighter. So if lending standards stay the same or for some reason increase, like we know that in March, the bank bailout program is ending. Okay, so the Federal Reserve turned on the money printer after Silicon Valley Bank and the other problems that popped up, Signature Bank, those. And they said, hey, you can bring us our assets. We'll give you face value for them and we'll hand you cash so you can prop yourself up. That goes away in March.
So basically they need to get their crap together before then.
Bingo. That goes away. It goes away mid-March. So if by mid-March banks aren't ready, that could, and of course Congress can extend this. But let's just assume, because we're on the dark side right now, let's assume they don't. Well, if bank liquidity dries up and their balance sheets aren't clean enough, then lending standards have to increase. If lending standards increase and it's harder for buyers and investors to qualify, that could hurt home prices. Overbuilding. Overbuilding technically did happen in 2004, 5, and 6, and it is one of the things that led to the Great Recession, was we overbuilt in that new construction space. I don't see this happening, but if for some reason, let's just say
in our local market,
not in our local market, but in most markets, okay? So in our local market, it's never happening. We're too liberal.
Yeah.
We'd have to massively decrease regulation, but the same thing would also have to happen across the country. You'd have to see a massive decrease in regulation, and you'd have to see massive funding go to the builder side and that relax. Here's one that also hurts. So what's going to happen in 2024, politically?
An election.
We've got the presidential election coming up. So do you like it neutrally when the presidential elections pop up?
Personally?
Yeah, personally.
I do, of course.
Do you like all those negative ads that get run though?
No. All the campaigns and all that type of stuff you're talking about? Yeah, no.
So as the election nears, what traditionally happens to real estate is the real estate market slows down, and you can see a 10% drop in total unit count sales. That's not prices, in just sales, because of fear, because those election ads start running.
Why is that? I always hear, at least from the time that I've been in real estate for these number of years, is that people are always like, oh, it's an election year. I'm like, what does that mean?
It's the FUD.
Because I've literally never seen it affect the real estate market.
It may not affect you. So you have to think about, true. There's a difference between a professional like you and there's a difference between the average agent in the market. So I love that it doesn't affect you, but from just a raw statistics perspective, the market slows down. Well, why does it slow down?
Fear in the market.
Just the fear.
Because people hear, it's an election year, I got to be careful.
And they get overly worried about what one man or what one woman may do as the president. And they believe that individual can affect things more quickly than they can. Other things that could hurt us, speculative bubbles. Go back and look at crypto. As crypto mooned, everyone's a moon boy. They're like,
diamond hands.
Yeah, diamond hands to the moon. Let's go. And they're just betting and betting and betting. When that bubble popped, it hurt a lot of people. So speculative bubbles in any asset class, crypto, gold, real estate, as they pop, they can affect home prices.
Yeah.
Next, recessions. A mistake people make because of the Great Recession is we make the assumption that all recessions are like that and housing will behave the same. Let's go back through history.
Probably because that's just the biggest one that most people who are alive have been through.
Bingo.
I mean, there's all these tiny ones that maybe in your industry you didn't even feel, but that was the one that probably the most people were tied to.
And the most people got hurt that are still alive.
Yes.
So our mind, we avoid pain, we go towards pleasure, and we go, man, that was painful. Even if you didn't own real estate, you may remember what your parents did, or maybe you lost some real estate during that. So what happens is we assume, because of the Great Recession, that home prices always go down. And the reality is home prices don't always go down. statistically, they actually are flat or they go up more than they go down in a recession.
And really, if I'm not mistaken, that crash happened because of the housing market and what was happening in the housing market. So it was the catalyst that did that.
Yes.
So that's what really ultimately was affected the most.
That was our first housing-based recession caused by housing.
It's actually crazy if you haven't looked into it. I mean, obviously we're in the industry, so we know about it, but just knowing what kind of regulation there is now with getting a loan, I mean, it seems pretty standard. It's like, how much money do you make? Okay, well, let me check on that. Before they're just like, how much money do you make? You're like, $100,000, and they're like, sounds good.
Yeah. So maybe you should have to prove how much money you make.
Yeah, you know, it's pretty wild. I mean, when you look back on it, you're like, no, like, how did no one see that coming? Like, that's insane. If you knew anything about the lending restrictions, they just didn't even do any due diligence.
Next on the list, government policies.
Yep.
Government policies can vastly affect the value of real estate. So let's give an example, because we like land development, we like investing. You can have a tract of land, and its zoning could be residential, and government policy comes through, and boom, all of a sudden it's high density, multifamily, or commercial. Well, the value of that land or that house may have just doubled or tripled overnight. The same works in reverse. Government can come in and they can pass a law, pass a regulation, and all of a sudden massively devalue real estate. We also can't discount natural disasters. Natural disasters are on the rise. You know, Texas had those massive power outages because of all the freezing rain.
Yeah.
Okay. We've seen more hurricanes, hitting Florida and the coast.
Tennessee just got hit not too long ago.
Yeah. Yeah. Well, wasn't that like a big tornado or something?
Yeah.
So you've got these things that are happening, and that can vastly affect real estate prices. What's happening with insurance right now?
Insurance is going up for everybody. I mean, at least in this local area, insurance is regulated by every state. And so I know that in Washington specifically, which is where we do business, everybody's calling and is like, why are my rates going up? This is crazy. I mean, they're jumping $300, $1,000. I just helped a guy whose home insurance just doubled. He had $1,300 and now it's $2,600.
Oh my.
Yeah, that's crazy. And right now, though, there's a lot of variables that go into that. I mean, everyone's heard inflation, inflation's the cause of all, it's like the big boogeyman, but really it is. When you start to think about it, these insurance companies are paying for car repairs. Used vehicles are up I think 47% still in prices. I mean, even my wife's car just got hit. And so even just to get an estimate, it was 2 months.
Yeah, wow.
To get in line just to have someone look at it. Because there's all these crashes. I mean, they're all over the place. So I talked to actually a rep at one of the companies that we work with. And because all of that stuff is on the rise, to give you an example, this is how much they're paying out. Q1, this insurance company paid $750 million in claims.
Oh my.
Q2, they paid $1.5 billion in claims, not combined with Q1, just Q2 was 1.5 billion. So I haven't checked in with him and asked him what Q3 was, but everyone is raising rates right now. They're going to start tightening their regulations as well. They're going to start looking at people's driving record and be like, I don't know. He's kind of a risky driver. I think we're not going to renew him. They'll just be like, we're just not renewing you anymore.
Yeah.
If you're that much of a liability to them, why would they keep you like
that? Exactly. And then there's also, they showed a stat on injury claims as well. So people who are injured in a car accident, and I don't know if this is because of attorneys being able to sue car insurance, but they're just getting they're like, oh, you have a $50,000 limit for car accidents? Yeah, we'll just take it all. We'll just someone gets an attorney and they just sue, and it's insurance company has to pay out that full deal if they win. So, which happens quite often.
It's crazy.
So everyone gets to pay for all the other stuff that goes on. Everyone's rates go up to pay for it.
So one of the things that people don't think about is when you're in a multifamily situation and you own a building or just commercial real estate in general, the value of commercial real estate is based on its net operating income. And so if insurance, which is
the actual market value.
The actual market value is based on the net operating income of the asset.
Got it.
So as insurance and taxes, and we've seen property taxes do the same thing. So as insurance and taxes go up, the net operating income goes down and the value of that asset goes down. So what's crazy is, and I read this in the CPI numbers, there was one point this year where insurance was up like 26% across the board. Well, if you take your expenses for a commercial building, let's say it's multifamily, and all of a sudden the expenses are up 10, 15%, that could drop the value of that asset by millions of dollars because it's so expensive now to operate. And we know that rents have been kind of flat. So let's land the plane, finish this one out. Global economic factors. So because our economy is tied globally, as wars happen, as conflicts happen, as supply chains fall apart, as trade tensions build, as geopolitical issues pop up, as foreign investment in real estate changes, okay, that all can affect home prices. So I want to go to one crazy example to finish out just this last topic. Do you guys know about the Chinese property developers, Evergrande?
Yep. They were like one of the largest, weren't they?
So Evergrande, they went under.
Did that officially end?
It hasn't ended. It's one of those like slow moving tsunamis that's affecting. So the Chinese economy as a whole, a very large percentage of the Chinese economy is actually based on real estate.
And it's very speculatory, isn't it?
Extremely. And so what happens is because they can't get all the wealth out of China, everyone goes and buys more apartments. They go buy more houses.
In a different country?
In China.
Okay.
So they park their wealth there, but then all of a sudden everyone looks around and is like, well, Luke owns 20. Mutually, man, he owns 30 and I only own 1. FOMO kicks in. We start buying more. So there's millions of vacant units in China. But what's crazy is when you look at these developers, Evergrande already happened. And the latest one, a Country Garden. Country Garden just missed a huge bond payment.
Are they a Chinese building company as well?
They're one of the largest Chinese land development builders in that area.
Is that the one that they said was bigger than Evergrande or something like that was also in trouble?
I don't know the answer to that.
All right, sorry.
No worries.
I heard something about it, so that's why I was curious.
So they just missed their payment. And then last week, the investors voted not to call the option on the loan, so they gave them a little bit of a reprieve. But when they miss these bond payments, these interest payments, it's like a house of cards and the dominoes are falling. So if Chinese real estate starts to fall dramatically, there are U.S. companies that are invested over there that has the potential to affect the U.S. economy and the U.S. housing market. So these global economic factors we have to consider as possible ways to force prices down. Okay. Last but not least, of course, there's speculation that, what if all the hedge funds left all at once? Okay. You were just mentioning as we were starting. Tell us about, what you and I were talking about off camera.
Well, I was actually listening to a podcast on my way here in regards to, they had gotten on the topic of, I think there's like a bill that's being proposed to make it so that hedge funds like BlackRock and Vanguard and State Street or whoever like the big players aren't going to be able to buy real estate in the US anymore. And I think they're, if I'm not mistaken, they're buying real estate in these large portfolios, like in REITs, right? Is that like what it is? Or real estate something, I don't know what it stands for. It stands for something like that.
They're doing it as REITs. They're also doing it as hedge funds. They're also doing it as funds. They're doing it as private equity. They're doing it as every vehicle you can think of.
And, that also, when I got to thinking about it, that also plays a huge role in home prices here. I mean, BlackRock and these other companies, they will pay over market value for someone's home, probably like even up to 20% more, 30% more, maybe, just to be like, I'm taking the whole lot. Like there was a project that was here down the street from our office, came on, I think it was like 20 units or like 15 units or something like that, townhomes. And they just bought every single one at like full, like more than full price. I think they were just like, give me the whole project, and they're all rentals. So it could play a huge role because they are making inventory tighter as well, because those homes that they're buying are never going to come back on the market. Yeah. I mean, they're just going to get sold to they're going to get bundled up in a package and be sold to another hedge fund or something like that.
So in one of our previous episodes, we talked about exactly that. So we'll put a link to that in the show notes, in the comments, and you can go watch that one. But essentially, there's two major bills that are in Congress right now. Unfortunately, it looks like neither one of them is going to make it. They're going to be dead on arrival.
Yeah, there's no way. There's going to be so much money thrown at them. It's not going to ever go through.
Now, I think there should be some type of regulation there to cap it off. However, we don't want to stop investors in general from investing in the U.S. housing market and creating housing and stock, because
it's a slippery slope.
It's a slippery slope.
Yeah.
And that's why the government tax incentivizes investors in general to invest in real estate, because that creates a stable society. However, hedge funds do own 4% of real estate. And so you don't want that number to all of a sudden become 10%, 20%. And there are markets where they control over 10%, and those are specifically in the South and in the Midwest, where housing is more affordable. And in those, they can affect the whole market because they proportionately own so much inventory.
Yeah, but I mean, their real goal is to collect rent, isn't it? That's what the reality is. So they don't really care that they overpay for the property. They just want the rent. And the Midwest is where, the good rents are, really. In ratio to home values.
Bingo.